It took me over 15 years and a lot of mistakes to get my portfolio to 1.7 million. And if I had to start from scratch today, before I bought a single individual stock, indexed ETFs are the foundation I would use to build my portfolio with. The problem is a lot of beginners, and this was me too, start off the exact opposite. We begin by buying individual stocks that look exciting before buying ETFs to build that foundation of diversification. That strategy can work if you're patient and lucky, but it leaves you exposed to a lot of stock market swings or just plain bad news in some of the stocks that you own. So today I'm going to show you the 3 ETFs that I think every investor should buy before they get into individual stocks. One of these I've held for years. It's sitting in the portfolio that helped me get from 0 to 1.7 million. And the other two are ones that I would buy if I were starting from scratch today. Now each of these ETFs does a different job and the order matters. So let's start with the most important, the foundational one, VTI. VTI is the Vanguard Total Stock Market Index Fund, and think of it as owning a piece of every US company. There are over 3,500 stocks in the fund that you get with one share, and you do it for a very low cost. The fee is 0.03% per year, so less than $5 on every $10,000 you have invested in the fund. And that's about 1 percentage point below what you might pay for an actively managed fund, and those barely ever beat the market anyway. The top holdings are names you're already familiar with, companies like Nvidia and Microsoft. These are some of the biggest, most profitable companies in the world. Now, VTI I've owned for years, and it's currently my go-to place for any new cash that I want to put in the market when I'm not shopping for individual stocks. Now, if you like index funds, you've probably heard of one of VTI's biggest competitors, VOO. That's the Vanguard S&P 500 index. I view both of these basically as interchangeable, but I do like VTI a little bit better because of the extra diversification you get by owning 3,500 US stocks versus just the 500 that comprise the S&P 500. There are two big drawbacks to this ETF as far as I see it. The first is a tech focus. 9 of the top 10 holdings are tech companies, and they're the ones I already mentioned, things like Microsoft and Nvidia. And that's a consequence of the fact that this fund is built on market capitalization, and those tech companies happen to be the biggest companies in the US market right now, so they're going to be over indexed. But that just means you have to be careful if you already own a lot of companies like Nvidia or Microsoft in individual stocks. You're getting more exposure by owning VTI. And the second drawback is its US focus. The company does not own any non-US stocks. So if you want exposure to emerging markets or mature markets in places like Europe or Latin America or Asia, then you're going to have to do that some other way. So VTI gives you that growth foundation, but it doesn't pay you much while you wait. The dividend yield is just 1.2%, which is exactly the same as in the S&P 500 right now. So the second ETF on this list is designed to fix that issue. We're talking about VYM, that's Vanguard's high yield dividend ETF. So where VTI was chasing the biggest companies in the US market, VYM is specifically targeting companies that pay above average dividend yields. We're talking around 3.2 to 3.5%. And that's passive income that's hitting your account every quarter just for holding this stock. That yields about double what you can expect from owning the wider market. It's more than double, in fact, than both VOO and VTI. 3 things I love about VYM. The first is sector balance. You remember how VTI was so packed towards the tech world? Well, VYM does not have that issue. The top companies are in places like financials, healthcare, and consumer staples. Companies like JP Morgan, ExxonMobil, Procter & Gamble. These are boring businesses that in some cases have paid dividends for 50 or more consecutive years and have raised them every year. So that's exactly the kind of stability you want to have in a foundational dividend ETF. The second thing to love about VYM is its defensive strength. When markets drop, dividend stocks tend to do a lot better. Take 2022 for an example. That year, the tech stocks dropped by more than 30%. Even VTI was down by more than 25%. But VYM, it was essentially flat. It fell by less than 1% in 2022. So that tells you that it's a very good defensive play. And it's good to have insurance like that when tech stocks could fall at any time. And the third reason to like VYM is its rock bottom expense ratio. We're talking 0.04%. Again, essentially nothing compared to that 3% dividend yield that you're getting every year. There are some drawbacks. The main drawback I see is that you're giving up some growth to get that income. A good example is that VYM is up about 120% over the last 10 years compared to VTI's 230% gain. So you do have good insurance against a big tech drawdown. However, you are giving up some of the gains during a rally like we've seen over the last 10 years. So you've got growth covered with VTI and now you've got income covered with VYM. But the third ETF is one that I think a lot of beginners miss, and it's the one that gives this portfolio its edge. We're talking about DGRO, and the benefits right there in the name. That's ticker symbol DGRO. That's the iShares Core Dividend Growth ETF. And this targets where VYM targeted companies that pay above average dividend yields. This one's targeting companies with above average growth in their dividends. So the dividend yield is going to be a little bit lower. It's about 2.1%, which is less than that 3.2% or so that you'd get from VYM. But these are dividends that are growing quickly, and you can see that the math is going to help you accelerate your returns over time. The expense ratio for DGRO is another big benefit to owning the stock. Again, it's well below 0.1%, so less than $10 per $10,000 invested. And the top holdings, you've got some really big blue chips there: Microsoft, Apple, Home Depot, Johnson & Johnson. These are really high quality companies with great balance sheets that have a great track record for boosting their dividends over the last decade and more. Now, if you've done any research on dividend stocks, you've probably heard of SCHD. That's another very popular dividend one. Schwab's version of basically the same idea. SCHD is excellent too, and I view these as almost interchangeable. They're peers, to be honest. But DGRO is slightly a bit more diversified, whereas SCHD has a longer track record, but either one works here. The reason DGRO makes this list for me is simple. I've lived this experience of compounding dividend returns and what it can do for my portfolio. Apple is one of my top holdings, and it's one of the top holdings in DGRO. And I bought the stock about 15 years ago, and the dividend has increased significantly over that time. And now my yield on my initial cost is roughly 20% in cash every year. So that's a powerful demonstration of what compounding dividend growth can do for you. And that's why I think an ETF like DGRO belongs in every investor's portfolio. And of course, there are drawbacks, as there are with any stock purchase. The first one I've kind of already mentioned. The yield is lower than you would get from a high dividend yield ETF like VYM. You're getting around 2.1% compared to roughly 3.3%. And the second is we're still US focused. So the same as in the other two ETFs, we're focused on US companies, but I'm doing that by design. So there it is: VTI for growth, VYM for high income, and DGRO for income that grows with you over time. Those are three ETFs doing very different jobs, but complementing each other really well. Now, I want to be honest with you, I don't own just ETFs. I do own a lot of individual stocks, but if I were starting over today, before I bought any individual stocks, I would start with ETFs like this to build that portfolio. If this was helpful, consider subscribing or hitting that like button. And if you want to see how I built my $1.7 million portfolio, check out this next video.